economy in Canada is not that strong already anyway. I think several people have pointed out that if you adjust for the population growth, which has been, if you count temporary residents, it's been pretty spectacularly, it's up over the 2% annual rate. We haven't really had any GDP growth. We've been in a GDP per capita recession for a couple of years now. So
where are we in the Canadian housing market crash? I have with me Hilliard Macbeth, who wrote an amazing book on the housing market crash in Canada. We're going to be getting into where we are in the crash and many other things in this interview. Hilliard, it's an honor to have you back with us. How are you doing today?
I'm doing wonderful, and it's great to be talking to you again. It's been a little while, I guess a year or two, but lots has happened in the in the Canadian housing market since then. It's just amazing.
It is, yeah, it is. And I'd like to kick it off really with, you've probably seen it a million times, Hilliard, and I'll bring it up on screen. Hopefully you can see this as well. Basically, it's just this chart where you've got the bubble cycle essentially. And I'm just kind of wondering, in your mind, because you've investigated not just the Canadian bubble, but many bubbles within your book, whereabouts do you think we are? Do you think we're in that denial, return to normal phase, or do you think we're more heading towards that fear phase now, or do you think we're somewhere else even?
Yeah, I think we're still in the denial. I mean, there's a lot of talk about the rate cuts happening soon, and there's still a very large, probably the majority of the people. I saw one of the reports saying that I think it was more than 60% of the people believe next year will be a good time to buy a house. So interesting. Obviously, they're holding off till the spring, let's say, to wait for interest rates to come down, but they're not really factoring in the possibility that prices could drop further. So prices have already dropped, especially in Toronto, not so much in Vancouver, but in Toronto, there's some bargains starting to show up, but especially in the condo market. But really, if a 500 square foot condo was selling for $750,000, now it's selling for $650,000, that's not the kind of bargain that you get in the fear stage. So it seems like we're not quite in the fear stage yet. And I know you have that other chart that I do every month that you can see. It's actually kind of interesting because the little squiggle in that you can see the little squiggles there. You can see it basically goes back to 2022 when the three markets. We've got Toronto, Vancouver, and then we've got the Canadian market in the dotted line in the middle. So Vancouver is the one that's held up the best. It dipped and then it's rallied, and it's dipped and rallied. Toronto is actually, in some parts of Toronto, substantially lower than it was in 2022. So it looks like 2022 is going to turn out to be the peak, and so we're 2 years into this, which. It's understandable. Some people might think that that's enough, right? 2 years is a long time, but we're really, a big part of my thesis was there would be a bursting of the bubble, and the bursting of the bubble is not just a small dip like that. When you look at the bottom of that chart, you've got inflation, and you've got income from wages, after-tax income from wages, and you've got the CPI and the shelter index. So for that gap from the four lines at the top and the three lines at the bottom, the gap is huge. So a true bursting of the bubble would bring it down to maybe where, just to pick a number, 250 to 350 in that range there on that chart. There's a big white space beside it. That would imply, let's say 300, halfway between those two. That would imply, house prices had gone up threefold in 25 years. So that's still a phenomenal rate of growth. It's just not quite the rate of growth that we've seen, but it would still be a pretty substantial rate of growth, and it still would be higher than inflation and higher than income. So we got a long way to go if the true deflating of a bubble actually happens. And the thing is with deflating of bubbles, which people, because it's been so long since we had a deflating of the bubble, is they generally tend to deflate all the way back to the trend line that was in place before the bubble formed. So that would, in this chart you're showing now, would indicate that dotted line there. And this is a generic thing. It doesn't have anything to do with Canada or the US. There's obviously some estimates in that. But Grantham is the genius of bubbles, I think, and he said that they all deflate back to the trend line that was in place before I forget how many. He studied 30 bubbles, I think. Now he was talking the stock market, not the housing. So I'm the one that took it from the stock market to housing. He didn't check the housing bubbles, and they may be different a little bit, but in the stock market, he said that all of the 30-something bubbles that he discovered, they deflated all the way back to the trend line. And he said most of them actually go well beyond the trend line. In other words, they go well below the trend line in the deflating of the bubble. So and that we're talking about the Canadian housing bubble today, but we could also talk about the U.S. stock market and the S&P 500, because it would be the same situation where there's a bubble there. And Grantham recently has indicated that he believes that will deflate as well. So that'll be, he says, it'll be in the stock market. It'll be the equivalent of the 1929 or the 1999-2000 deflations, which were pretty severe. The obviously everybody knows 1929. Most people know the 2000. We were talking 70-80% decline. So 20% to truly deflate the Canadian housing bubble to get back to housing is not enough. It would just be a pause in an upward trend. If the prices started to return upwards again, which I think is what the majority of the people believe now, at some point they might go a little bit lower, then that wouldn't be the end of the bubble. That would just be a continuation of the bubble. And we've had that. We had it in when the home capital crisis exploded. We had it, and then that was in 2017, I believe, and then in 2020 when the COVID epidemic hit, we had another situation, and both times outside forces jumped in with some money to prop the market up and keep it going. But this time it seems like maybe that won't be possible. There isn't a lot of room left to, even with cutting interest rates very rapidly. I have a feeling that it won't be enough to keep the bubble going this time.
Yeah, because even the debt, I think I read on Better Dwelling last week, is mortgage debt outstanding is something like $2.3 trillion, which, that's bigger than even the government can handle. And it's kind of crazy to even think about that number, but it's just absolutely massive. And do you think that one of the signs maybe where we get, and I'm just really throwing this out there, do you think one of the signs would be like mortgage debt, when mortgage debt actually starts to, because it's been growing at such a rapid rate, eventually you would expect when the bubble really starts to deleverage that mortgage debt would start coming down as well, as more and more bad loans get uncovered? Or do you expect that to kind of continue growing regardless of the fact?
Yeah, no, I think mortgage debt would start to shrink, and that's a very, very difficult thing. So we're talking about a recession now. So if you get a situation where mortgage debt, so that chart that we looked at, we didn't mention that red line that was in the middle of those three housing lines at the top of the chart. That's the debt, the household debt. So household debt is that red line, and you can see it's 5.5 times what it was in 2000. So that's, that growth rate is well over 10% annually, and that is a pretty amazing number when you think about that. So that is household debt. So that includes actually mortgage debt, which is about 80% of it, and then HELOCs and credit cards and car loans and just unsecured line of credit. Just all that stuff. So, and it's a little bit behind, like it's, I think that those numbers are, the housing price numbers are almost like only about 3 months old on average, but the household debt number is probably more like 6 to 9 months old. It takes a while to get reported. But so when that rolls over, it starts declining, and it never really, for the longest time, it hasn't declined. The last time it declined was probably in the 1990s. And it would be a very severe downshift in the economy, because the economy in Canada is not that strong already anyway. I think several people have pointed out that if you adjust for the population growth, which has been, if you count temporary residents, it's been pretty spectacularly, it's up over the 2% annual rate. We haven't really had any GDP growth. We've been in a GDP per capita recession for a couple of years now. So
this video was powered by ExpressVPN, helping you protect your privacy with the world's fastest VPN and the VPN that I use. If you want to take advantage of my special offer, go to expressvpn.com/marketmania. Let's get back to it.
For mortgage debt to start shrinking, that takes a lot of demand out of the economy, because if we need to, at this point, I think, point out how important debt is to our economy. And I started out as before I became a stockbroker and then a portfolio manager and an analyst and an author. I started out in graduate school in economics, and I'm a dropout. So I was working on my master's, working towards, thinking about going to PhD at Queen's University in Ontario. But what I discovered was that I loved the math, but what really bothered me was that there was very little connection between what the economists were looking at and doing all these fancy mathematical analysis of, and the actual real world economy. And it was totally theoretical. There was no practical into it. So I decided to drop out and became a stockbroker. So there were a couple of, keep the story short. So, and certainly the stockbroker world is very real and very gritty, and it was completely different from an academic career. So, but one of the neat things that's happened in the last 10 years is with writing the book is I met a guy named Steve Keen, and he's got a book called Debunking Economics, and you may have run into him, I don't know, but he pointed out all the flaws in the mainstream economic system, which basically are all the things that bothered me about it when I was in graduate school. I didn't really understand the full story, but Steve Keen has laid it out in several books, actually. And one of the key things that relates to what we're talking about in housing is economists completely ignore money, debt, and banking. So money, debt, and banking are the most important things to the economy, pretty much, in terms of making it go. And so if you take the influence of debt, for instance, that red line we saw out of the GDP and out of the economy, economists are looking at a very, very limited understanding of what's going on in the economy. What they assume is that banking takes money in from depositors and then lends it out to borrowers, and they act as an intermediary. And people in the Federal Reserve, as recently as Janet Yellen, indicated from their public statements they still believe that this is the way it works. And this is totally wrong. It's not the way it works. And it's been pointed out by the Bank of England and Steve Keen and a bunch of people that that's not correct, including me in my books. And so without that ability to create money from the banking system, the slowdown in the economy, and Steve Keen calls it credit, which is the annual increase in the amount of debt in the system, the slowdown in buying power in the economy is dramatic. And it leads to a very severe recession. So we have not tested this. So we came very close to testing it in 2020 when obviously the private sector stopped borrowing money, stopped spending money because they were at home. A lot of them were out of work. They couldn't really go to the bank and get a loan anyway. So what the government of Canada did, and all the governments in the world pretty much did, was they stepped in and in the Canadian case, I know the numbers, it was about a $500 billion deficit. So a huge deficit in Canada prior to that was 20 or 30 billion, and they made it more than 15 times as great and stepped in and did that. So that money was there to make up for the lack of spending by the private sector. But it had the really interesting and unfortunate side effect that people took that money because basically the government spent the money into the economy, just like a bank creates money when it makes a loan. Yeah. And they took that money that they got and they went and bought housing with it, which is, I'm sure, shocked the people in the government. It certainly shocked me. I was that's where you got that peak on that chart we saw in 2022. That was the impetus there. People took their money from the government, their COVID money, and look at the way those lines shot up there, and including the debt line as well. So the debt line had been growing along there, 7%, and now it's maybe a little bit more per year, and then it started to go up at maybe more like 9 or 10% per year. And that's pretty amazing when you consider that there were quite a few people that were out of work during 2020. So they managed to get their hands on the money. It was money that was spent in the economy by the government. And then, of course, the banks, and I don't have any way of knowing this for sure, but my guess is that the banks were told to be cooperative in terms of facilitating purchases. So, for instance, one of the stories was people in Toronto were cooped up on their little 500 square foot condos, and they bought houses in Peterborough or places like that, or Oshawa for $1 million without even seeing the house. Now we know that they didn't have time to sell. There was no way to sell their property in Toronto. So this was an additional purchase on top of what they already owned. It seems very unlikely that they would have qualified for those loans without some kind of a easing of the financial conditions that the banks usually present to borrowers that are buying a second or third home. So. Yes. And that, those prices in Oshawa, for instance, have come down quite a bit more than the 20% that single-family homes have dropped in Toronto. But getting back to the mortgage, because we started talking about mortgage debt, and this all links together. So when the bank issues a and most of the people that are listening to this have experienced this. They go to the bank, they sign the forms, and I remember the first time I did it was probably 1980 or 81 or something. It was quite shocking to think that the next minute all this money appears in your bank account. Now, you can't just take that money. They don't let you just take it and spend it on anything. It has to go into the house purchase that you've agreed to make as part of getting the mortgage loan. So it leaves, in most cases, it would leave your bank deposit. It's created into your bank account as a deposit, and then it immediately goes to maybe another bank. It becomes a deposit in another bank, and then it goes to the seller of the house, which would then deposits in their bank account. But before you signed those papers, that money did not exist, and people question this. There's, as I mentioned, there's Federal Reserve economists that still believe that money came from somebody's account, savings account. Yeah. Was lent out to the new home purchaser. But the problem with that is that when you try and go and examine, well, whose account actually dropped by, say the loan was, maybe it was a $900,000 loan to buy a house in Toronto, whose account dropped by $900,000 in order for that loan to be created, $900,000, it doesn't happen. So it's new money. And so we know that that's the case. The Bank of England did studies of it, and other economists have done studies of it. And but the other way we can prove that it is new money, beyond just the idea of taking the money from the savings account and lending it out to the borrower, is that red line on that chart that we were looking at could not have grown faster than the lines at the bottom. So the lines at the bottom are a rough proxy for the economy, the GDP. So we've got after-tax income, we've got the CPI. Generally, that's roughly the pace of things. And for the debt on the red line up there at the top to be moving up that fast, the savings accounts would have to be dropping by that same amount. And that would mean that there would be a tremendous headwind on consumer spending, and it would be very hard on the GDP. So you'd have to create that amount of savings in the economy to do this, the system that unfortunately mainstream economics is still using as their model for how debt actually works. So the rapid pace of growth in that red line on that chart is a signal or a proof that banks can actually create money by making loans. And now it doesn't apply to non-banks. So non-bank lenders actually have to, there's all these shadow banks about a lot in the last little while in Canada that were making the loans that other banks refuse to make. And they do need to actually raise the money from investors in order to have the money to, because they don't have access to the central bank's system that allows the charter banks to create money when they make loans. So the other source of money in the economy we alluded to already is the ability of the government to run deficit financing. So they can very much create money into the system by spending the money into the system, because they don't actually have to. This is another myth in the economy that is widely thought of but misunderstood, is that the government has to raise taxes in order to have money to spend. And that is not the way it works. The way it works is the government first spends the money, and then they have the ability to create that money in the act of spending it into the economy. Then they can decide if they're going to tax some of that money back or all of that money back. And this is quite likely. I mean, there'll be studies done for a decade or two about what happened during COVID. It's quite likely that the fact that they spent all that money into the economy during COVID and then failed to tax most of it back was the cause of the inflation that we saw afterwards. But now we're at the point that stimulus from the COVID is wearing off. Obviously, it's mostly wearing off, I think, and the incredible increase in household debt, especially the private sector debt, but especially the household debt, is also wearing off. The rate of growth is slowing down, even though it doesn't show up in that red line. The red line, as I mentioned, is out of date. The latest numbers we see have the mortgage debts in Canada declining, or at least not growing as fast as the economy. So that those two headwinds are going to be pretty severe. And so it would be normal to get a recession at this point in the cycle.
This is the end of part 1. If you want to watch part 2, then subscribe to the channel or check out the podcast channel. Check it out in the links in the description below. I will see you